Welcome to this episode of Retirement Crusaders. We're going to look at some hidden mutual fund fees. So if you own mutual funds, you've got to watch this video. Now, when I was a financial advisor, one of the things I focused on was helping people reduce their fees and expenses for their investments. And I remember one woman, she came to see me and I said, well, what are you paying in your mutual funds that you have now? And she says, well, I don't pay anything. Now, hopefully you're not as naive as this woman. Just because they don't send you a letter and say, here's what you're paying, or the advisor doesn't spell it out, here's what you're paying, that they don't make it transparent, doesn't mean you don't pay those fees. So today we're going to peel back the curtain and look at the fees you're actually paying. For a teaching exercise today, I picked a fund called Capital Income Builder. Let's take a look at this. So the basics of Capital Income Builder, it's a pretty good sized fund, $104 billion under management. This fund started in 1987, and it's a mix of, as you see here, U.S. equities, 42%, non-U.S. equities, 33%, and then U.S. bonds. So this is what you would call a growth and income fund because it's got a mixture of stocks and bonds, plus it's diversified not only in the United States, but outside the United States. And, you know, this fund has done reasonably well. As a matter of fact, if we scroll down here, you'll see that Morningstar gives it overall 5-star rating. So they like this fund a lot. So now what we want to do is look behind the curtain. And where do we look? Well, you've got to read the prospectus. Now, every time you buy a fund, you get a copy of the prospectus by law. And maybe you've thrown these things out, which is fine because you can always find them online. So let's pull up the prospectus for Capital Income Builder and see what we can see. If you like this kind of investment education, please hit the subscribe button below and the little bell icon so each time we post a video, you'll get a little notice when you log on to YouTube. And below in the description, please see a link. We have 10 different booklets on different retirement topics. Click the link. They're absolutely free. Read them and enjoy them. And there's also a link to join our Facebook group where we can have group discussions about anything you'd like to talk about. So here's the Capital Income Builder prospectus. Now, you'll notice it's a total of 74 pages. The good news is we don't have to look at 74 pages. Because one of the things you'll see, fees and expenses of the fund. They actually put it nicely organized at the very beginning of the prospectus. So let's scroll down here and take a look at and see what we can see. All right. Now, the first thing I want to explain is that mutual funds come generally in two classes. And this is a fund that is sold through financial advisors, or stockbrokers, or financial planners. So this isn't a fund you'd buy direct, it comes through an intermediary. So the first class of shares they have are called Class A. Now the bad news about Class A is that there's a sales charge when you buy it of 5.75%. Now, if this is disclosed to most people, and the financial advisor should disclose it, and the financial planner should disclose it, sometimes they don't. They just hand you the prospectus and figure, oh, you'll read about it if you really want to know. Now, some investors would say, 5.75%, I'm not paying that kind of commission. And the mutual fund industry has said, okay, don't worry. We've invented something called a Class C share. And what's the difference? Here. On the Class A share, you have to pay this 5.75% to get into the fund. For the investors who balk at that, they say, oh, no problem. We'll let you in for nothing. No commission when you buy the fund. But let's take a closer look at the difference. On the Class A shares, you will pay, let's scroll down a little bit. By the way, you won't pay this exit charge. You won't have this. That very infrequently, only people who invest $1 million or more and sell their shares within 18 months. So you don't have to worry about the exit charge. But let's scroll down here. On the Class A shares, you'll notice the management fees 0.22% a year. Now that's pretty reasonable. That's not bad at all for a fund. Next thing, there's this thing called distribution 12B1 fees, and that's 0.25%, a quarter percent a year. Now, what is that? Well, it's something that doesn't do you any good. As a matter of fact, it's almost irritating because here's what the fund is saying. We're taking a distribution fee out of your fund to help us find new investors. Doesn't sound right. Well, it's not. But lots of people pay this because they don't know any better. Now you'll notice, remember those Class C shares? They didn't have that upfront sales charge. But look what happens. If you get the Class C shares, then you don't pay a quarter percent a year. You pay 1% a year for those distribution fees. And this comes right out of your fund. They don't send you a letter telling you they're taking it. This is in the prospectus, and they just scrape it right out of your fund. Okay. Next, there's something called other expenses. Whether it's Class A or Class C shares, doesn't matter. A and C are the same, 0.12%. So we have total fund operating expenses. For the Class C shares, it comes to 1.34. The Class A shares, it's only 0.59. Why? Because you had to pay this very steep sales charge to get in. Now, one of the things that the mutual fund companies have to show you is what happens over time if you look at these fees. And here's what they show you. That if you invested $10,000 in the Class A shares, let's not look at 1 year because that would be very expensive to buy the shares, pay 5.75% and sell within the year. Let's look at a longer time period, 10 years. So they show you that over 10 years on a $10,000 investment, given all the costs, the fees in this fund, you would pay $1,270. Now, if you bought the Class C shares, which remember the C shares, you didn't have to pay that 5.75% commission going in, but because it has higher annual fees, you're going to actually spend more over a 10-year period. So in other words, what I'm saying is Class A, Class C, they're taking plenty of your money in fees and expenses. If you like this kind of investment education, please hit the subscribe button below and the little bell icon so each time we post a video, you'll get a little notice when you log on to YouTube. And below in the description, please see a link. We have 10 different booklets on different retirement topics. Click the link. They're absolutely free. Read them and enjoy them. And there's also a link to join our Facebook group where we can have group discussions about anything you'd like to talk about. Now, below this area where we go through what the expenses cost you over 10 years, there's this little section that says portfolio turnover. Now, most investors might look at these fee schedules and they kind of ignore this. And this may be the most important section of the prospectus. Because in this fund, what they tell you is that for the last year, the portfolio turnover was 87%. What's that mean? It means that during the year, out of, let's say they had 100 stocks. Let's take a simple example. They had 100 stocks. During the year, they sold 87 of them and replaced them. That's 80%, 87% turnover. Now, turnover is not a good thing. There's two costs to turnover. One of those costs is it increases your taxes on the fund. And secondly, it actually decreases the return on the fund from a problem called slippage. We'll talk about both of those. So first, let's take a look at taxes. So what they show you here is, and this is an example using a different class of fund shares, but it just shows you the examples. An example. So they show you what the fund earned before taxes. They show you what it earned after the tax on the distributions, capital gains or interest that they distribute, and then what it earned after taxes and distributions, and if you sold your shares. So let's look out here at 5 years, for example. So the fund earned an average annual return of 8.39% over 5 years. But once we take all the taxes out, notice that your return drops from 8.39 to 6.31, a little over 2% due to taxes. Now, clearly, if you own this fund in an IRA or 401k, you don't have to worry about the taxes because the taxes will be the same in the end no matter what. When you withdraw your money, you pay ordinary income rates. But if you own the shares outside of a mutual fund, you're going to be hit with a pretty hefty tax bill. Why? Because this turnover creates taxes. Every time the fund buys or sells, and let's assume for a minute they make a profit. They're going to lose money on some trades, but let's assume every time they sell a stock, they make a profit. The problem is because the turnover is so high, 87% a year, most of the gains that they're making, most of the profit are short-term gains, which are taxed how? At your ordinary income rates. If they had low turnover and were holding these stocks at least a year, it would be capital gains rate and your tax would be much lower. So the reason this fund has such a bad tax drag is because they're turning over the portfolio often and creating short-term gains, which are more expensive for you. Now, I want to take a look at this other problem that turnover causes. And this is a totally hidden cost. It's called slippage. Now, if you called up the fund, any fund you own, talk to the customer service department and say, I'd like to talk to you about the cost of slippage on your fund, they'd say, huh? What? Because not only do the front end people not even know what that is, the executives, they don't like to talk about this. And the Securities and Exchange Commission, who tells these funds what they must put in their prospectus, every time they bring this up to the fund managers, you should really show the cost of slippage in the fund. The managers say, oh, it's too hard to calculate. We can't show it. It would just confuse people. And they've gotten away with this for decades. What is slippage? Well, if you or I buy 100 shares of IBM, we are like a drop in the ocean. 100 shares isn't going to matter if they trade 5 million shares a day. But if a mutual fund comes in and buys a position, say 1 million shares, that pushes the price of the stock up. So let's just take an example, hypothetical example. It's 8 in the morning. The shares are selling for $60 each. The fund comes in and says, we want to buy 1 million shares. By the time they're done buying their 1 million shares, what's happened? Well, I show you in this graph. The $60 has been pushed up to $62. Who bears that cost? Well, you do, because the shares have just gotten more expensive. You're a shareholder in the fund, so all of the shareholders in the fund bear that $2 cost that occurs because the fund is so large that it has an impact on the market, and we call that slippage. Similarly, when the fund sells shares, let's say at 8 a.m. in the morning, they were $62. By the time the fund has sold their 1 million shares at the end of the day, they've pushed the price of the shares down and they've netted only, say, $60. Now, this is a hypothetical example. These slippage costs might be more or less, and they depend on the type of security. Blue chip securities are able to absorb these purchases and sales bigger, and the slippage is probably much smaller than I'm showing. But if it's a NASDAQ item with thinner trading during the day or during the year, it's going to have a much bigger impact. The point I'm making is this is a totally hidden cost that you never see. It's never spoken about, but you bear it. How do you bear it? Well, without this cost of slippage, maybe the fund would have earned another % a year, which becomes a big difference over time. Now, at Retirement Crusaders, we are not big proponents of investing in mutual funds for a whole variety of reasons. We like individual stocks and bonds, so I think funds are fine for a lot of people, and if you like to invest in them, that's fine. However, you want to be careful about all these fund fees. And generally, you want to gravitate toward, funds from Vanguard or no-load funds from Fidelity, or just make sure when you look in the prospectus the fee profile is low and the turnover is low. One of the reasons that ETFs, exchange traded funds, have become popular in the last decade is because the turnover in ETFs is very low, say 10% a year. What's that mean? Small slippage costs and much lower taxes. And that's why they're beneficial for investors. Plus, they have lower expenses to begin with. Overall, the management fees are lower. Now, I've indicated why high turnover is bad. I just want to show you an academic study from some professors and what they concluded about this. Now, I've got to put on the glasses so I can read this. Sorry. This is 3 different professors did this from 3 different universities: portfolio turnover activity and mutual fund performance. Now, they came up with this thing called modified turnover, where they didn't measure it by the year, they measured it by the calendar quarter. And here were their conclusions. Modified turnover measure relies on portfolio holdings, takes into account effects of offsetting trades and fund flows on the turnover. We find evidence that the modified turnover predicts lower performance. Here it goes. The comparison between the highest and lowest quintiles, in other words, the top 20% of all performing funds and the bottom 20% of all performing funds. Modified turnover reveals a difference of a negative 2.41% in annual risk-adjusted returns. So what they're saying is that the top 20% of funds and the bottom 20% of funds in turnover, there's almost a 2.5% difference in their performance because of the high turnover. What else do they conclude? Our overall results suggest that frequent churning of a portfolio, high turnover, is a value destroying for investors and signals a manager's lack of skill. So they're pretty harsh. They're saying the only reason a fund would have high turnover is the manager didn't know what they're doing and he keeps buying and selling to figure out how to make you money. Now, they may be a little harsher than reality, but it's one way to look at things. And just to show you another chart called When More Means Less, this shows you over time the tax drag can severely limit your return. And they actually show you for different taxpayers. See, a lot of taxpayers that are retired might pay 0 capital gains tax, and on short-term capital gains, maybe only 10%. So clearly for them, the cost of taxes is noticeable, but it's not that significant between these two. However, for somebody in a higher tax bracket, it's a killer. This high turnover can really kill returns when you own funds outside of an IRA or 401k. Now, if I haven't irritated you enough about mutual fund fees, I'll just show you one other thing. These are not additional expenses. They were included in that management fee and other expenses that I showed you in that table in the beginning. But I just want to show you what some of those costs actually are. They're basically kickbacks. So this fund pays these investment firms, Wells Fargo Advisors, Morgan Stanley, Fidelity, etc. They pay these investment firms a kickback. In fact, so they paid Morgan Stanley last year $1.1 million. Why? Well, Morgan Stanley says, hey, give us a little money and we'll push your funds a little more with our advisors. And so they say, okay. Now, they talk about this here. It's to offset processing costs and other things. It's a kickback. There's no other way to say this in a nice way. Now, not that that's necessarily bad. It is included in the disclosed expenses that I showed you, but I just want to give you an idea of what actually goes on in the mutual fund business. Please be aware that mutual funds are a product, just like any other product. They're sold by advertising, they're sold by salespeople, and please be aware when you're buying a fund that it's something being sold to you in many cases, and it's got expenses that are disclosed, but you've got to look at the prospectus. See you next time on Retirement Crusaders.